Hello, my name is Emmett, and today I'm going to be showing you guys how to make a pairs trading algorithm from scratch. So you don't need to know anything, and we'll go over a little bit of the theory and then go over the code and show you some of the stuff that we're doing. So first thing we need is two highly correlated assets. So the red and the blue are an example of this. Right? These two assets roughly move the same, right? When one is moving up, the other moves up. When one goes down, the other goes down. They don't need to be the exact same line, right? If one had a much higher price than the other, that's still okay. They just need to move together. So this ratio of price between the two, where blue looks, I don't know, let's say roughly twice the price of red. As long as that stays the same, they move together. That's all we really care about. So to give you some examples, the classic example when teaching pairs trading is Coke and Pepsi, right? Because essentially they are the same soda. Say what you will about, the flavor and things. They're both kind of generic cola sodas, and they're sort of horizontal on their supply chains, right? They both produce pretty much the same product, and the things that affect their businesses are very similar. So if there's an increase in inputs to production, right, the cost of their flavoring or sugar or bottles go up, both companies will be negatively affected. And if demand for soda goes up, right, they find some new chemical like aspartame that's supposedly healthier for you because it's lower sugar, lower calories, and demand goes up, well, both companies will prosper. Pratt & Whitney and Boeing, they're sort of vertical on the supply chain, where Pratt & Whitney makes jet engines, Boeing makes jets, they make planes. So if Pratt & Whitney is doing really well, it's probably because they're selling a lot of engines to Boeing, which is also doing very well and has the money to go and buy a bunch of jet engines. So they're very closely tied together. Where if demand for planes go down, well, demand for jet engines also goes down. And the final example is sort of a gotcha, like a gimme, which is Saudi Aramco and WTI, or the crude oil index. This is not like a classic example, but you can sort of get a company and the index that it is a part of, as long as it is a sector index or commodity index. And the company inside of it will trade roughly correlated with the index as a whole. So in this case, is Saudi Aramco, which is the national Saudi oil company. If it's doing well, it's probably because the price of oil is nice and high. And so they're making a lot of money, which means the crude oil index probably also went up because all the other oil companies are making a lot of money. Or if demand goes up or supply goes down, whatever it is, right? If Saudi Aramco is doing well, the crude oil index tracking all the other oil companies is also going to go up. Now, this doesn't work for ETFs like the S&P or the NASDAQ or Dow or Russell 2000, because those indexes, the companies inside it, are not related in the slightest. It's just the largest market cap or the biggest ones in tech or whatever it is. But they have no relation to each other. So in that case, the indexes would not be correlated with any companies inside. And even so, some of this has to do with how companies compete against each other. So they might not be correlated with the index, but this is sometimes something you can do. So now that we have some examples of things that are, correlated, how do we make money off of pairs trading then? So this is what we're looking for to make a profit. This little difference in price here. See, we're watching them, and we see they're moving together, moving together, moving together, and then here, there's this big difference in price. So one goes down, one goes up. Now, as quantitative investors, we don't really care why it is that they've differed in price. Maybe one did an advertising campaign. Maybe it's just a bullish investor who had a lot of money and pushed the stock price of one up. But for whatever reason, the ratio of price between the two has dramatically changed. Where they used to be trading roughly 1 to 1. Now it's sort of like, 1.5, 2 to 1, right here. And so what we do, because we know that these are tightly correlated assets, is we go and short the asset that went up, the blue asset, and we go long or buy the red asset, the one that went down. That way we can capture this upward movement and capture this downward movement as they return to their normal trading prices. So what does this look like in actual code, in plain old Python? So we have some imports here, some definitions, and we're making a class, an object. You'll see we make the object here, right? Pairs trading, we pass it into our backtester and spit out some metrics. So we're trading Coke and Pepsi. You'll see where SPY comes in later. Don't worry about it for now. So the first thing we have is our constructor, where we first define a sliding window. This is pretty standard. This is just to keep track of how these companies have been moving recently, right? We don't want to know the ratio and price from 20 years ago. We want to know what it is now. So you have a sliding window, could be 30 days, could be 90, 60, 120, however you define it. Could be a whole year if you wanted. We then define a Q for the ratio histories to keep track of with the length of our sliding window. So this is how we keep track of the most recent trading prices. And finally, we define our positions and weights, which right now is just closed out, 0, 0. We don't want to have any money in the market. We haven't even, seen what the prices are. So stay out of the market. So now we're going to go down and look at this calculate weights function. So this is what's going to get called every single day, right? Where it's going to go and get the prices from the exchange, pass them as a parameter, here as a dictionary, and it's going to calculate the weights for us, and it's going to return a dictionary of the weights like we have up here. So the first thing we do is we get those prices for our two different stocks, and we do a little error handling, making sure that the prices aren't none. If they are, for some reason we don't have a price. This can happen if you have you're trading securities on two different exchanges, and maybe one exchange doesn't trade on the weekend, but one exchange trades 24/7. So you might have this situation. Then we say just return the previous weights. So don't touch our portfolio. It's an assumption that the difference in price of one day isn't significant. So you got to keep that in mind. So then we calculate the ratio and price and append it to our history. We start building up our sliding window. And we check if we're in our warm-up period. So what this is doing is making sure we've seen enough data to be confident in our trading. So if the length of our ratio history, so if the number of prices we've seen is less than our sliding window, return the previous weights, which if you remember from the constructor up here, right, it's just 0, 0. So we just want to stay out of the market. Like don't do anything until we've built up our entire sliding window of ratio histories. So once we get past this part, because we finally seen enough prices, we've been trading long enough that we have our sliding window ready, we can start to calculate a z-score. Now this is sort of statistics. You can research in it. If you've taken an intro to stats class, you've probably seen this before. But essentially, a z-score tells you how unusual the value you're seeing is compared to the distribution you have. So if we look at our current ratio and we subtract the mean, if you think about it, if our ratio is pretty much average, that means when we subtract the mean away, we'll be left with roughly 0. So our z-score is going to be 0. So values that are centered around 0 are very standard. They're usual. We expect them. But values far away from 0 are unexpected. We also go over here and divide by the standard deviation, because not all assets trade at the same level of correlation. Some of them might differ more than others, and so we divide by the standard deviation to sort of standardize what the z-score is. So now we have this measure of how unusual the prices are. So in this case, this would have a really high z-score right here. But these values, pretty low z-score, because they're all roughly, the average. So now that we have this z-score, a measure of how unusual it is, we try to calculate what it is we should be investing in. So, we take a look at our z-score, and if it's greater than 2, and we're not already in a position, or in this position, we're going to go, and we're going to go long in the first asset, and short in the other one. Now, to go short, you probably have a negative weight like that, but for the Husky Quantitative group, as of right now, we don't do any shorting, because we don't want to risk the possibility of going negative. So it's we would just sort of divest or buy an inverse ETF if we're trading ETFs. If you remember from before, price history is P1 over P2. So when it's positive, we're going long in the first asset and short in the second one. Okay. Same thing, but swapped around. So if you think about it, it'd sort of be if the blue asset went down and the red asset went up, right? The opposite position, where the z-score is less than -2. We would then short the first asset and go long in the second asset. So those are our two ways to enter the market. And finally, to exit the market, we would check if the absolute value of our z-score is less than 0.5. So are we sort of centered around 0? Are we close to 0? And if we are close to 0, close out the market. We've captured these movements, and we're back to the normal, the expected ratio that these assets are trading at. And finally, just return previous weights if none of those statements hit. Then record the weights and return them for that day. So what does this actually look like? Well, let's take a look. We have a little backtesting script someone wrote, not sure who. Oh, you weren't supposed to see those. That's later. So yeah, we have a little backtesting script that's running in the background. Hopefully you're using the Husky Quantitative dashboard to do your testing. And so you saw from before that SPY is included here. And SPY is our benchmark, actually, for our equity, but we're going to ignore it for now and just focus on Coke and Pepsi. So you can see here, this is a graph of weights over time, and you can see where we're going long in Coke or going long in Pepsi and shorting the other one. So this gives you a general idea. Okay, we're going long in one sort of half the time, long in the other half the time. So if you were to see that one color was really dominating, maybe that would tell you something about the assets you're trading or your algorithm. We also have the equity over time. And this is where we see things are not so great. Overall, we're losing money, right? Our Sharpe ratio is negative, CAGR negative, total returns negative. We're losing money over time, and our max drawdown is pretty violent, right? We have a lot of volatility as well. And so you can see this is probably where our max drawdown happened during COVID. We were in the market, COVID hit, and our portfolio tanked with it. Then we had that quick bounce back, but it doesn't really matter because our max drawdown is measured from this giant drop here to the very bottom. And overall, we're losing money. So that means on average, when we enter the market, we're making bad trades and losing money. So what do we do about this? Right? Obviously, we could tell not a good algorithm, but what can we change to make it better? First thing, sliding window. You can make it longer, you can make it shorter, you could play around with that. You could go through and change the threshold for your z-scores. Maybe you want to enter at a z-score of 3, right? Greater than 3, less than -3. Maybe you want to do 1.5. You could also change how you exit the market. Maybe you want to exit at a z-score absolute value of 0.25 or 0.75 or maybe even 1. And you could also change how much you're investing. Maybe 90-10 doesn't work for you, maybe 80-20 is better, maybe 95-5, whatever it is. But what we're going to do now is, if you remember, we had these flat sections that we're looking at, right? All these little flat sections when we're not in the market. In reality, those are not flat because of inflation. True, the dollar value is the same, so on the graph this does make sense, but in reality, in real terms of the money, we're losing value. So what we should be doing is investing that money while we don't know, like while our two assets are trading at their normal prices. So this is what I changed before. We calculate our weights like we normally do, and we notice that in a closed position, we should invest into the last asset in our universe, which in our case is SPY. So this means you can go and take the money that's not being invested right now, the position is closed out, and you invest it into SPY, where you know you're going to at least get some returns, you know you'll make some money. So the money isn't just sitting there, you're fighting inflation, hopefully making a bit of a profit. Now, the S&P 500 is not a safety asset, right? If you wanted to do something that was safer, you should probably do a bond ETF, maybe treasury bill ETF, something along those lines. But for now, we'll just do the S&P because that is what our benchmark is, and you should always be comparing your algorithm to an appropriate benchmark. So this is what you saw before. The green areas used to be empty, it used to be white, but now it's filled with the SPY. So while we're not invested in Coke and Pepsi, we're putting our money into the S&P 500. And so now this is a much nicer looking graph where we're going up over time. We don't see these crazy bull runs that the S&P has, and unfortunately we still do see the massive dips during COVID. And matter of fact, our max drawdown got worse because we're now more correlated with the market, but our Sharpe ratio is overall better. Now, 0.6 is still not very good. This is still very high volatility, but it's getting better. It's much improved from before. And so the real thing I would point out is this section over here, where the S&P had this really, really big drop, and we didn't feel it as much. So we must have been doing some pairs trading during this period. And sort of same thing here, right? Kind of big drop, not so big for us. And for, about a year-ish here, we actually were beating the S&P. So that's pretty neat. And I think the biggest improvement you can do is picking a better universe and trading more stocks. So you could, instead of just doing Coke and Pepsi, which in reality are actually not that correlated, you can find much more tightly correlated assets out there. Coke and Pepsi are, funnily enough, kind of poor examples of this. But you could find much more correlated assets where pairs trading would be a lot more effective, and you could pairs trade multiple pairs. So you could do Coke and Pepsi, and you could do, I don't know, like Kellogg's and General Mills cereal, right? You could do all three of the examples I showed you, right? Coke and Pepsi, Pratt & Whitney and Boeing, Saudi Aramco, WTI. So that would also help improve it. That way, as you're going short and long in those down periods where you're not invested in anything, instead of just dumping money in the SPY, maybe you'll have other opportunities. And the diversification will help smooth out that curve to not be as jagged. So yeah, I mean, hopefully you learn a thing or two, and you understand a bit more about developing quantitative trading algorithms. And I hope this helped you. If you have any questions, hit me up. I'll do my best to answer them. And have a good day.